Welcome to today's first lecture in financial risk management. We have now arrived at part 4, which is risk measurement. As you remember, risk management process usually entails, first of all, the identification of the different types of risks, and then in risk management we move on to measuring and modeling risk. And after having measured and modeled risk, we then look at different strategies how to deal with risk. So here we are now talking about risk measurement. And as you can see from the outline, we start with some very basic principles of risk management before we move to a more theoretical and axiomatic theory of risk measurement and of risk measures. Actually, this comes from mathematical finance. And then we turn to some selected important risk measures, and most notably the value at risk and the expected shortfall. And last but not least, we see some basic standard procedures for calculating VaR, which you will all find in almost any textbook on financial risk management. Okay. Now, in this last part of the class, we dealt with various risk factors that usually might influence, could influence losses from different investments. We've seen that, for example, for an investment in a portfolio of bonds, we have the interest rate level and possibly the credit spreads, more precisely the default probabilities, as input variables, as risk factors that drive the potential financial losses. And at this point, we have at least a basic understanding of what causes financial losses. For example, we have an investment, we have a set of risk factors, we have a risk mapping, and we know that these potential losses are possible. We probably then know that there is a stochastic or a statistical distribution for the financial losses for our investment. And now we have to ask ourselves, how should we operationalize risk? What should we use? Should we use the actual statistical distribution? Probably not. In many cases, with continuous random variables, we have an infinite number of outcomes. We have some basic information on the probability mass, but we want the information to be condensed into single ratios, into just a single figure. And for this, we need risk measures. Now, risk measures should also be economically sensible. What is meant by this? You could come up with any kind of risk measure. For example, I could do how should I put it? The most basic idea to measure risk could simply be to say, I have these two distributions, and my risk measure would simply be minus 500. Yeah? Understood as a worst case scenario. I simply assume, in any case, I don't care what the distributions look like, I simply assume the risk to be minus 500, a potential loss of 500 euros or dollars. Now, this is obviously not an economically sensible way of measuring risk. It simply is an assumption I make, and I have to do better. Okay, so this is also something we'll have to look at. What is an economically sensible measurement of risk? In the first chapter, we've already seen an example of a risk measure. In the form of the so-called Greek of the Black-Scholes-Merton option pricing formula. Do you remember what the Greeks are? The Greeks are what? Mathematically speaking, the Greeks are, yes?
Derivatives.
The derivatives of what?
The pricing function.
Yeah, with respect to the input factors and the input variables of the Black-Scholes-Merton pricing formula. So for example, the option delta is what? It's the first derivative of the option price function with respect to the underlying price, the stock return or the stock price. Meaning that these derivatives give you the sensitivities of the prices with respect to changes in volatility, interest rate, or the risk-free rate to be precise, the stock price, and so on. Now, again, sensitivities are later on not exactly the type of risk measure we are looking at, but they are risk measures and they can give you a first hint at what is going on. If, for example, you have an option investment and you can see that the option has a very high delta, a very high rho, a very high vega, you know that prices can go down quite quickly in case, for example, the volatility increases or decreases. Now, measuring risk on the basis of factor sensitivities has one serious disadvantage. The sensitivities of the portfolio value to changes, they cannot be aggregated. You cannot simply take derivatives, function derivatives of, for example, the option pricing formula and simply add them. You cannot multiply them. You can simply see that these are sensitivities of this function to this variable. And if you take a different investment, you cannot combine them. This is one disadvantage. Can you think of a second disadvantage? If you were to interpret the derivative as a sensitivity, this would be more or less a percentage change in y for a 1% change in x. More or less, being mathematically not very correct, but still it's a percentage change, it's a ratio. And in risk management, we are usually interested in monetary units. We want pecuniary units and a pecuniary risk measure, meaning if we have an investment in an option, we want to know how large could our potential loss be. 200, 500,000, or maybe 1 million euro. But not 3.2% or whatever, but we are interested in monetary units. Okay. Now, risk management is, in the end, it's all about risk aggregation, diversification, and finding the right mixture of risky investments and hedging instruments. So, a risk measure that is not able to aggregate risk is not what we are looking for. So we will probably not use the Greeks. Another possibility, very simple possibility, to come up with a risk measure is scenario analysis. For this, we simply consider a set psi of risk factor changes. Those are just scenarios, and a weighting vector W with some weights between 0 and 1, and then let there be an arbitrary risky portfolio with an associated risky loss operator L. Then the portfolio risk can be measured by maximum of W1 times L of X1, and so on, up until Wn times the loss for the nth scenario. What does it mean? It simply means that, remember, we saw in the part on risk mappings that actually we are not so much interested in changes in the financial position itself, but in the end it all boils down to changes in risk factors. And those changes in risk factors, those were X1 and X2. And we now assume, for example, that we have a function with two risk factors, X1 or X. Let's put it this way. X1 is the risk-free rate, and X2 is maybe a stock price. Okay. Then X1 here is simply a set of two changes in these risk factors. For example, plus 1%, minus 3%. X2 could then be a different scenario, -3%, -8%, and so on. And we have different scenarios for those two risk factors. And we then include those scenarios in the loss operator, meaning that we get a potential loss L1, we get a potential loss L2, and so on. And then we weight them. For example, this is highly unlikely, so it gets a weight of 10%. This is very likely, and it gets a weight of 0.9%. And then afterwards, we take the maximum of the set, and in the end, our risk measure is what? It's the maximal weighted potential loss with respect to scenario 1, 2, 3, or 5, or 6, and so on. And this would be a very simple way of measuring risk. As the name suggests, it's a scenario analysis, meaning that we are considering hypothetical scenarios that could be likely, that could be highly improbable, and we've just constructed them, just like I did it up here. And in the end, this is a very crude way of measuring risk. In fact, however, this way of risk measurement is used by the Chicago Mercantile Exchange and the HKEC, the Hong Kong Exchange and Clearing, to determine margins. What are margins? Who can remember what margins are? In an exchange, especially in a futures exchange. Any idea? Yeah?
Most of the contracts are nowadays settled by cash, so they have cash settlement and not physical delivery.
Yeah?
And since there's always a risk that the price may develop favorable for one party and unfavorable for the other party, these losses have to be compensated on a daily basis. So the
Why?
because if the person that is owing money is not able to fulfill his or her obligations up to that date, then the
Yeah.
possibility that he won't fulfill the obligations on a day in the future if the development
Because
if there's an unfavorable or even
yeah, you have the right idea. Losses could accumulate to a point at which the buyer or seller of a future contract is no longer able to holster those losses and to accept those losses. And if he or she is not able to pay up, the exchange will simply tell the investor to close the position or to pay an extra margin into the margin account of this trader. So these are margins. These are payments you have to make to the exchange to guarantee the fulfillment of a future contract. And these are margins. And here at Hong Kong Exchange and Clearance, it says where a client maintains a margin account with the exchange participant, he will be required to pay margin on both long and short positions based on span. Span is a risk-based portfolio approach for calculating the daily margin requirement, which has been developed by the Chicago Mercantile Exchange, CME. Span simulates how the portfolio would react, the portfolio usually of future contracts, would react to changing market conditions. Obviously, the risk exposure of a futures position is the futures price movement. For an options position, apart from the price risk, changes in volatility also act as another major factor in affecting its risk exposure. By the way, I did not translate this. Is this actually from the original? Therefore, SPAN evaluates the risk exposure of a portfolio by varying these two factors, and SPAN constructs scenarios of futures, price movements, and volatility changes to see what the entire portfolio might reasonably lose in the following trading day. So the exchange forecasts the future losses on the next trading day, and if the exchange sees that under this SPAN methodology, the losses are so high that all the money in the margin account is used up, the trader will be required to pay an extra margin into the account. So this is where this is used. Okay. One problem still remains. You need to come up with somewhat sensible scenarios. You could do it just the way I did. You could simply make them up. You can try to use an extreme scenario, extreme worst case scenario, and this might turn out to be difficult. Similarly, it is difficult to compare different scenarios with different amounts of risk factors. It's difficult to compare scenarios and results and risk measures from one scenario analysis to the next one, because there is so much leeway in the way you come up with those scenarios. Therefore, what is done in quantitative risk management in the end is usually one only looks at statistical distributions, loss distributions, or P&L distributions. This is the foundation, I would say, of almost all of quantitative risk management, and it's all about statistically modeling loss distributions and taking moments from the conditional on unconditional loss distributions. Now, the idea that the loss distribution of a portfolio and moments thereof is sufficient to adequately reflect the risk of an investment can be justified in the following way. First of all, we are mostly interested about losses. Sometimes we don't even care about the profits, but in the end, we are interested not in sensitivities, not in percentage changes, not in derivatives of any function, but in the end, it's all about money. It's all about losses, potential losses. So if we take and estimate certain moments of a distribution, it would give us a monetary unit. Second of all, loss distributions can be aggregated. You can simply take X and you can add it to Y, and you get a new random variable Z, and you look at the distribution of Z. So they can be aggregated, at least theoretically, at different stages and different levels. The portfolio, the company, asset classes, what you like. Then netting and diversification effects can be modeled, and this, for example, is very difficult when it comes to using percentage changes and ratios. And loss distributions can be compared with each other. If you have one distribution that looks like this and another that looks like this, you can compare those two distributions and see that their moments are different, that they have different values, different quantiles, different means, different volatilities, and this is another advantage of using a loss distribution. There are two disadvantages, and I would assume that a better part of quantitative risk management simply deals with solving these problems. First one is loss distributions can only be estimated on the basis of historical values. You could, of course, also assume a distribution, but this is very risky in terms of model risk. If I were to say, okay, my losses are distributed according to a normal standard Gaussian distribution, this is an assumption I make. Why? I don't know. Could work. In many cases, I at least have to estimate the parameters. I at least have to say it's a normal distribution, but I need an estimate for the mean, and I need an estimate for the standard deviation or variance, and I need historical data to do those estimations. So parameters have to be estimated. Assumptions need to be made on the question which distribution can be used, which parametric family has to be used, and we need data. In addition, this is just a result of the fact that we need historical data to estimate those models. We have large model risk. Just simply take this one. If we say we have losses and those losses are normally distributed, this means that, first of all, the whole distribution family could be wrong. It's not a T, it's not a normal distribution, it's a T, or it's a Clayton, or it's an extreme value distribution. Parametric family is wrong. Second problem could be the parameters are estimated in a biased way, or these are not the best estimates for the parameters. Could be a result of too little data, could be a result of me using my limited knowledge of statistics to estimate the parameters, could be due to computational problems. So in the end, those parameters are wrong. Then I could wrongly omit some of the important risk factors. Now, again, remember that for a bond, we have the risk-free rate and we have the default probabilities, delta I, or credit spread CI. And if we just leave those out, this would be a risk-free bond. And we would neglect the default probability of the respective issuer. In that case, we might have the right, correct model when it comes to the distribution. And the estimation is okay, and we use the correct data, but our initial model, that is the risk mapping, is already wrong, and we get incorrect risk measures. So wrong choice of mapping, omitting relevant risk factors, wrong estimation, data errors, and so on. All these are potential sources for errors in risk measurement, but these are just arguments for a prudent risk measurement and a prudent risk modeling, and not arguments against using loss distributions as a whole. So yes, loss distributions, but be careful. Okay. Just using loss distributions, like the one I gave before with minus 200, minus 100, and minus 50, is of course not sufficient. We need something else. We are interested in using a condensed measure based on such a loss distribution, and the simplest way to do this is to use some key figures, in other words, a moment and individual values of the loss distribution. Does everyone know what a moment is? A statistical moment. German, we have the same word, Moment. Moment der Verteilung. As I know, there are some financial mathematics students here who can explain what a moment of a distribution function is. No idea? Can you explain what a moment is of a distribution? Yeah? Have you attended a class on probability theory yet? Okay. Any other? A moment of a distribution is a generalization of the mean. For example, the mean is the first moment of a distribution, if my recollection of probability theory is correct. The idea, however, is that you can also estimate a second moment, a third moment, and so on, and you can centralize it, you can center it, and in fact the variance is also a moment of a certain distribution. That's just a generalization. And the mean, variance, kurtosis, skewness, those are moments of the distribution. Does everyone know what skewness and kurtosis is? In German, Wölbung und Schiefe, other way around. Skewness is Schiefe and kurtosis is Wölbung in German. First of all, how does this distribution look like? It's symmetric. Okay. Now, if a distribution departs from symmetry, we call this a probably skewed probability distribution. So this These are two examples of more or less skewed distributions, skew to the left and skew to the right. And then what is kurtosis? The adjective is actually fat-tailed. What is a fat-tailed distribution? Any idea? Yeah?
The possibilities are more even distributed? More even?
Actually, that might be true, but that is usually not what one thinks of when talking about fat tails. Actually, I think it's very good. You usually take a normal distribution. Let's assume this is the Gaussian distribution, and it's not really flat. This, for example, would be a fat-tailed distribution. It has more probability mass in the tails. Might be in both tails, might be just in the left tail. It depends, and you usually compare it with the Gaussian distribution. So kurtosis, this is, for example, the fat-tailed is a leptokurtic distribution. I actually don't know the opposite, because in finance usually we almost always have leptokurtic distributions, fat-tailed. No? The probability to have an extreme outlier in the left or right tail is higher than it would be for a normal distribution. And this is actually one reason why you should always be careful when using a normal distribution for financial returns. Why? Assume you have used this model, but actual data is this model. What could happen? Yeah? You are underestimating the probability of a loss, more precisely, of an extreme loss. You are seriously and horribly underestimating the probability of an extreme loss, meaning that if this extreme loss hits you, you will be going out of business. And this is why, for example, during the financial crisis, many risk models and risk management systems were heavily criticized for using the Gaussian distribution, because these models were not able to forecast the correct probability for an extreme loss, and those happened during the financial crisis. Okay. Now we want to take moments and maybe even individual figures, numbers. We could, for example, just take this number and say the minimal profit and loss. In other words, the maximal loss. That's just our risk measure. Yeah? We just take the loss distribution and take the maximal loss. Could be a very simple risk measurement. Now, what should we use? Sigma, the mean loss. Should we use maybe the median loss? Now, up until 1999, economists, financial economists and risk managers just used whatever they wanted. They never really thought about this in a theoretical way, and they just used measures that made sense to them in an economical way. Back then, in 1999, a paper was published by Arzner, Delbin, Eber und Heath in Mathematical Finance, which is one of the leading journals in mathematical finance. And they came up with a very clever idea of putting risk measures into a mathematical perspective. They just viewed risk measures as certain functions, and they made up a set of axioms that risk measures should fulfill in order for measurement to be sensible in an economic way. And we'll see this in a bit in this discussion of axiomatic risk measurement. Now, this is a very very simplified look at the theory of risk measures. Especially if you are interested in this, because you are studying mathematics or financial mathematics, I should urge you to have a look at that paper. It's very simple, actually. It's not very challenging from a mathematical standpoint, and it's also almost 20 years old. But it is actually one of the, I would say, most highly cited papers in mathematical finance up to now, because it suddenly opened the door to a whole new area of research on risk measures. Before that, everyone, especially practitioners, just used risk measures without thinking too much about the theoretical properties of this risk measure, of these risk measures. After this, everyone talked about risk measures and coherent risk measures. What they did is they defined a set of axioms that is, in German we have this good phrasing. An axiom is a unbeweisbare Grundtatsache. That is an axiom. It's just a law of nature. You cannot prove it. You simply set it as a rule, and everyone has to accept it. And we will see how these axioms play out in the end. Again, this is just a brief discussion of risk measures. However, I don't know whether you can take these classes here at Leipzig. I'm pretty sure you could a couple of years ago, but risk measure theory is big in financial mathematics. You can do a whole lecture just on risk measure theory nowadays. Now we start by considering a probability space, a probability field, and a time horizon delta. And we are using the set of all random variables that are finite almost everywhere. I have to explain this probably. Who can, again, I'll try this, one of the math students who can explain to me and to the others what almost surely almost everywhere means. In German, fast sicher, fast überall. It's actually as simple as it sounds. And it's only relevant in probability theory when you're dealing with probabilistic elements, yeah?
It means the probability that, in this case, the random variable is finite is 1.
Yeah. The probability that this property is given is 1. In other words, the probability that this property is not a given is 0. And why? In many cases, it is easier not to simply assume this is a property that is fulfilled everywhere. This is a very strong assumption. It suffices in probability theory just to say this is a property that is fulfilled almost everywhere, at least everywhere where it counts, where there is a probability larger than 0. And even if this property here, that the random variable is not finite, this might happen, but then with probability 0, and we don't care about it. Okay. So we are looking at finite random variables, and financial risk then represent a subset of M, which is again a subset of all finite random variables. What does it mean? It means a financial loss is a random variable. It's a finite random variable. So we just can write it, L is an element of the set M, and it's random variable. Now we next assume that M is a convex cone. That is, for 2 risks or 2 random variables, the sum and a positive scaling of risk again represent an allowed risk. So if we have L1 and L2, if we add them, we get a third random variable, and this one is again in the set of M. And if we scale one risk, it's again included in M. This just means that this is a positive cone, a convex cone. In German, it's a convexer Kegel. We just need this because later on we want to add risks and we want to scale them, and suddenly this is just a theoretical assumption. But imagine you would use infinite continuous random variables. This could result in a strange situation where, for example, you have a stock, you buy 10 stocks, and suddenly the loss potential is unlimited. It goes to minus infinity or plus infinity. So this should not happen. Simply by scaling or adding risk, the financial losses should not suddenly go to plus or minus infinity. Now, what is a risk measure? By a risk measure, we generally understand a real valued function on M into the real numbers, and nu L, with L being risk, that is a random variable, and nu of L is interpreted as the capital sum, which must be allocated to risk L so that it is perceived as acceptable by an internal or external decision maker regulator. What does it mean? The risk measure, regardless of how this function nu looks like, is always a monetary number, dollar amount, that needs to be put into the position or can be taken out to make it acceptable to an external omniscient regulator, for example, to the SEC, to the BaFin. If this risk measure is less than 0, the risk is acceptable and the amount of minus nu can be withdrawn from the position without the risk being perceived as unacceptable. So, first of all, we have to see that there are two possibilities. In many cases, if nu L is positive, this is the required amount of risk capital. We need to put some money on the side to make this risk acceptable to the regulator or to our CEO. In the opposite case, that this risk measure is actually negative, this means that we can even take money out of this investment and it is still acceptable. Yeah? Works a little like a checking account. For example, if you have 5,000 euros in your account, you can withdraw 5,000 and it is still acceptable to you. Yeah? And in the other case, you need to put some money aside as risk capital. Now, the first axiom is translational invariance. The risk measure, nu, is translational invariant if for all random variables and each L, the following applies. If we add this and a random number is a safe and risk-free amount of money. If we simply add L to the risk measure of this combined portfolio is the risk measure of L plus L. And I always have to make sure that this is correct. Let us think about it. If actually is L is equal to I think this should be minus. I have this discussion with the students every year. Yeah. And for some reason, it's always wrong on this line. What happens? We have a risk. Assume you have a random variable and a potential loss L. Now, by adding 5,000 euros to your account, you are reducing the required risk capital by exactly 5,000 euros. Huh? Imagine you have a loan and you need 10,000 euros. If you put 5,000 euros into that account, you don't assume the loan to shrink by 6,000, but you assume that the loan only shrinks by exactly the 5,000 that you were entered and put into the account. And this is translational invariance. It means if you have risk, and this risk needs to be hedged with a risk capital amount of nu L, and you put a safe amount of money into this account, into this portfolio, the total required risk capital is reduced by just and exactly L, and not by more and not by less. No? And again, if we add nu L, the risk capital needed to make this risk acceptable, we can see that we can hedge the position fully and get a total risk of 0. Translational invariance comes from geometry. In geometry, you have objects, for example, in 3-dimensional space, and in many cases you have operations and functions on objects, and if these functions are translational invariant, it means that for example, the object is simply moved across the space. But it's not enlarged, it doesn't shrink, and it only changes its position. It seems a little bit weird that why would one be interested in, for example, shrinking or enlarging things. This is actually quite interesting in computer graphics and in the perspective. Because imagine, for example, in computer graphics, you are using a 3-dimensional object and you are projecting it on a 2-dimensional screen. And on this screen, you need those 3-dimensional objects to appear smaller if they are further away in the room and larger if they are supposedly very close to the screen. And then you have to take those objects and you have to shrink them or you have to enlarge them. So in geometry, you always work with projections, and these usually change the shape of objects. But if it's a translational invariant operation, the object is simply moved from one place to another and the shape is not changed. The second axiom is subadditivity. The risk measure is subadditive if for any two risks L1 and L2, the following applies: the risk capital for L1 plus L2 is less than or equal to the risk capital for L1 and the risk capital for L2. What does this mean? It simply means that you always have a non-negative, you always have a non-negative diversification bonus. You always have a non-negative diversification effect if you take two positions. Simplest case, stock investment, option. Both pose a risk if you look at them individually, but if you combine them, you have a hedging effect, you have a diversification. And this diversification effect will always work in your favor or it will be 0. But you will never have a situation in which the sum of all individual risks is actually lower than the risk of a portfolio in which you have combined those assets. You have diversification, and subadditivity reflects this idea that diversification takes place. Third axiom: the risk measure is positively homogeneous if for all risks L and all real numbers lambda larger than 0, the following applies: the risk capital for lambda times L is equal to lambda times the risk capital of L. The axiom simply states that if you have one stock and you need 100 euros risk capital and you now buy 10 stocks, you need 10 times risk capital, so 10 times 100. So nu L, let's assume, is 10, then this should be 100. This is not as intuitive and not as simple as this may seem. Why? Actually, you can change this axiom a little bit, and then you will later on see you get convex risk measures. Why is this actually, or might be a not very realistic assumption, especially when it comes to stock markets? Any idea? Yeah?
Maybe if you have enough stocks that are traded, the capital required goes up because you have a bigger impact on the market.
Yeah. In the end, it's liquidity concerns. Imagine you buy one stock of Daimler. No one cares that you have one stock. And if you sell it, you can actually immediately sell it on the market, and you will find market liquidity to be sufficient. But if you suddenly buy up 20% of all stocks, you suddenly become a major shareholder, and you will not be able to dump 20% of Daimler stocks to the market at the same point at a good price. So probably the risk of a very large investment is higher than a small investment at some point, simply due to liquidity considerations. So this might happen. And the risk measure is monotonous if for all, or if for any two risks, L1 and L2, with L1 is always this tech error. If for any two risks with L1 being larger, being smaller or equal than L2, the following is valid almost surely, almost everywhere. The risk capital of L1 is less than or equal to L2. And again, I think this has to be switched. What does monotony mean? First of all, you have to be careful with this here. In probability theory, there are several ways of defining inequations for random variables. And this is the most strict one. If L1 is less or equal than L2, this means that in any scenario, in any case, L1 is almost less or equal than L2. This is not, there are some other ways of comparing random variables. For example, you could simply take the means. Yeah? If the mean of L1 is smaller or equal than the mean of L2, you could also compare those two random variables, but this is the most strict comparison you can make. L1 is always, everywhere, less or equal than L2. Very simple example, if you have L1 here, and this is L2, then you can see that L1 is larger than L2. If, however, you have a third one that looks like this, you can see that in one scenario, L1 is larger, and in another scenario, L2 is larger, and then you cannot say that L1 is smaller or equal than L2. So this is a very strict assumption, that L1 is less or equal than L2 in any scenario. However, if this is the case, if we know that in any scenario L1 is always worse than L2, then we would say that L1 should also have a higher risk capital required for hedging this position than L2. Yeah?
Is U of L1 the risk capital of, in case of L1?
Yeah, U is the risk measure, and we've seen that in the definition of risk measures that this is more or less the capital sum needed to make this risk acceptable, that is the risk capital. If this is the monetary, the amount of cash needed to make the risk acceptable to an external or internal regulator supervisor, this is the risk capital.
And why did you reverse the bigger or smaller sum? Because,
It depends on how, it depends on how you define L1 and L2. Now, let's assume that L is a real valued profit and loss distribution. So positive numbers are profits, negative numbers are losses. then it would mean that L1 less or equal than L2, then this means that this here, this is the big one. This is the more extreme loss distribution and the worse loss distribution. But then this would mean that nu L, if a positive number is a capital amount that needs to be inserted to make it acceptable, then nu of L1 needs to be larger than nu of L2. Now, again, I mentioned this very early. If you take L as a finite, positive, real valued random variable, meaning that a positive number is a loss and profits are set to 0, then all the inequations change, obviously. Yeah? Then L2 would be would be worse than L2, and then nu of L2 would be higher than nu of L1. Okay. And the idea is simply that if you have two losses, if you compare two losses, and one is always worse than the other, the risk capital should also be higher for that one. It has to be higher. Yeah? If it's worse in one state and better in the other, we don't know. But if we can clearly say that loss 1, L1 is always worse than L2, then this has to be reflected in the risk capital measurement. Okay. Now, a risk measure that fulfills those axioms 1 through 4 is called coherent. This is a coherent risk measure. In German we have the same word, kohärentes Risikomaß. And the paper by Arzner, Delbin, Eber and Heath is also called coherent measures of risk. This is one of the basic results in their paper, that if you actually they don't actually do it with random variables. In the original paper they work with acceptance sets. They don't look at random variables. They start in geometry and they look at acceptance sets and then translate it to probability theory. But their definition is that if a risk measure is defined on the positive cone M and that fulfills subadditivity, translational invariance, positive homogeneity, and monotony, then it is called coherent. That's a coherent measure of risk. We've already talked, yeah?
Could you show what a positive cone looks like?
Actually, this is the one I defined earlier. So if you have a set of objects, of mathematical objects, and any sum of two objects and a positive scaling is again a unit in the set, then it's a positive cone, positiver Kegel. So, for example, let this be a set. If you have two objects, you add them and you get in here, then if the sum of those two objects is again in M, and if you take one object and multiply it with a positive number lambda, then it's again included in this set, then the set is called a positive cone. And obviously we need those two properties for positive homogeneity and subadditivity. For example, oh no, let's make it. This obviously is not a positive cone. Yeah? If you take 2 and if you take 3, you add them, you get 5. 5 is not included in the set, so 2, 3, 4 is not a positive cone. Okay. So this is a coherent risk measure. We've already talked about loosening this assumption on positive homogeneity. In fact, if we do consider liquidity to be an issue, then we need to relax this, and we come up with the definition of a convex risk measure. A risk measure is called convex if for any two risks and all lambdas being in the interval between 1 and 0, the following applies. Nu of lambda L1 plus 1 minus lambda times L2 is less or equal than lambda of the risk capital of L1 plus 1 minus lambda times the risk capital of L2. In this case, you don't have positive homogeneity. This is relaxed, but you get a convex risk measure. And in some parts of mathematical finance, convex risk measures are, I would say, equally important as coherent risk measures. Unfortunately, I would have to say that for a practitioner, this is of no real use, I guess. It is interesting to look at this theoretically and mathematically, but I haven't seen any real practical applications for convex risk measures so far. Might be wrong, but so far I haven't seen this. Now, this seems very theoretical, and it is. And as I said before, this was all started by financial mathematicians who just took well-known theory from probability theory to a whole new area of applied research. But although this seems to be very theoretical, there are two main points you should take from this. The first one is that actually for many practical examples of risk measures, you can show that those risk measures are coherent, they are convex, or they are not coherent. And actually the most important example of a risk measure that everyone uses in financial applications is not coherent. And that was a big surprise to practitioners to see that the one and only risk measure everyone was using had actually lacks some important properties. It lacks subadditivity. And the next important thing is that by looking at risk measures in a more theoretical way, researchers came up with new ideas for new risk measures, and they tried to invent new risk measures that possess these properties. So although this seems to be quite theoretical, the results are quite important for practice as well. So this is the theory of risk measurement. Let's talk about some important risk measures. We have only considered risk measures nu of L, so very generic and theoretical descriptions, and we now want to take a look at more specific examples. We start with, for example, the mean loss. We could take the volatility or the variance, or we could take the maximum loss. Now, actually, with our newly found background in theoretical, in the theory of risk measures, we can now see that all three risk measures are not doing so well here. First of all, variance is non-negative. It can be zero or it can be positive. That means, in terms of the definition given above of a general risk measure, it's actually not a risk measure, and this makes sense. We've talked about this, that volatility gives you an idea how wiggly the time evolution of stock returns, for example, is. But it doesn't tell you anything about how much money you should put aside. If you have a random variable that is very volatile because it's increasing so much and you only have profits, you would still get a positive volatility. Meaning and resulting in this basic observation that the variance or the volatility is not even a risk measure under this definition. The maximum loss and the expected value are not robust against outliers, not robust to outliers, and they generally provide far too pessimistic loss estimates, especially for daily risk measurement. And the maximum loss is independent of the distribution of L, more or less. And we will need to come up with different measures and different moments of the distribution L that hopefully fulfill all those axioms. And at one point or another, everyone needs to arrive at this point in a lecture on risk management. It's all about value risk. If you take a textbook on risk management from the 90s, and those still are still in our library. You will probably find risk management textbooks that have 90% just on value at risk. The value at risk, we will see the definition later on, was and still is the absolute and undisputed business practice state of the art for banks and financial institutions. It was, and actually worked like this. At some point, I think J.P. Morgan came up with a model to estimate default probabilities, and the system, this risk management system, was called, I think, credit metrics. And J.P. Morgan sold credit metrics to other banks, and in this system, the model estimated the value at risk of a financial position. And because all those banks bought credit metrics, and at some point everyone was using credit metrics, this developed into the industry standard for the financial sector. And then afterwards, regulators came and said, okay, well, as everyone is already using it, and this is the industry standard, let's put it in writing and let's include it into our regulation. Now, it was also amended and included in German supervisory law and regulation, the so-called Grundsatz 1. This was back in the 90s. And what regulators did was they allowed financial institutions, most notably banks, to use the value at risk. And by allowing banks to use it, everyone did so. Everyone used the value at risk. Now, this has also been incorporated into Solvency I and Solvency II for insurance companies. And actually, in Solvency II, things have evolved already. And people have started, and regulators have started to see the shortcomings of value at risk. And they now also ask insurance companies, require insurance companies to estimate different additional risk measures. But they started with value at risk. Now, from this point, from a theoretical point, the value at risk is not so much rocket science, it's actually just a quantile. And the most severe problem with it is that it is not coherent. Now, what is the value at risk? We look at a portfolio of risky assets, we fix the time horizon, and we take the distribution function of the losses. We don't care about whether the losses are linearized, how we've come up with the distribution. Let's just assume we've made our statistical model of the losses and we get L and the distribution function of L. The value at risk can now be interpreted as the maximum loss that is exceeded only with a given probability. Meaning, considering a confidence level of alpha between 0 and 1, the value at risk of a portfolio or a single investment at alpha is given by the smallest number L for which the probability that the loss exceeds L is not greater than 1 minus alpha. And then you have an exact, but probably not very intuitive definition. And it's much simpler. If this is the distribution, and you have alpha here and 1 minus alpha here, then, or the other way around, I guess, 1 minus alpha and alpha, it means that here you have 1 minus alpha probability. And that shows you that the value at risk is nothing else than the quantile, a quantile of the loss distribution. It's the 1 minus alpha quantile of L. And this is the right way of writing this mathematically speaking. Okay. Now, it suffices to say again, depending on whether you have a loss or a profit and loss distribution, you might be interested in this value at risk. If you have a loss distribution, you will probably take this VaR. So you have 1% here, 99% here. These are actual very good choices for alpha. You will usually estimate a 99% VaR, a 99.9%, and sometimes even a 99.95% valued risk. Yeah? So you are looking at a lower bound, or in other words, an upper bound for the losses, and lower bound for the profits and losses, and you're not interested in the most extreme loss, but you want a lower bound. And this lower bound for the profits could, for example, be here, and you separate 1% from 99%, and this is the VaR. Now, again, probably even be alpha equal to 99.9%, and the time horizon is often equal to 1 or 10 days in market price risk management. In credit risk management, it's usually 1 year, because no one really cares about credit risk in the short term if it's not a credit derivative. Yeah.
Yeah, when would you need a 99.95% confidence level?
If the regulator tells you to do so. Pretty simple answer. It gives you an idea of what the more extreme losses could look like. You go further into the tail of the distribution, but in the end, it's also a question of what the regulator wants. And they want to see the whole picture. Now, by definition, the VaR does not allow any conclusions on the amount of losses incurred with probability 1 minus alpha beyond the VaR, and this is interesting. Now, you have taken this class for, let's say, 5 or 6 weeks. This is maybe the very first time you've seen the concept of the valued risk. And I still remember many managers of German banks, not the private ones. I don't say whether it was the cooperatives or the savings and loan associations, but managers of German banks, actually executives, during the financial crisis, complaining and whining about, no one ever told us about the VaR, and we always thought that we are on the safe side when using the VaR. Who would have ever guessed that the losses could exceed the VaR? Yeah, because we have already used the 99% VaR, and for some reason we got hit by a loss that exceeded the valued risk, and no one told us about this. If you take especially German textbooks on risk management and you look up the definitions of the valued risk, you will probably still find definitions that are slightly inaccurate when it comes to the wording. In German, they usually say, now we've seen that the VaR is the value of the loss that is only exceeded in alpha or 1 minus alpha % of all cases. Now, in many textbooks, you could still read a definition that goes like this. The VaR is the loss that is only exceeded in up to 1 minus alpha % of all cases. But you see the difference? By definition, the VaR is a quantile, and it should be exceeded in 1%. So if this is your VaR, and if this is done on a daily basis, and you do, let's say the 5% VaR, then 5% are below the VaR, and the VaR should be exceeded on 5 days. And you should be in the clear on 95 days. Again, German bank managers sometimes mistook this definition to say it should be exceeded only in 0 up to a maximum of 5 days. But this is very unlikely. And then they used the 1%, the 0.1% VaR, and thought, oh, we're using such a small VaR and such a high confidence level, there is no chance that this could ever be exceeded. Well, during the financial crisis, they got a big surprise. And by simply looking at this definition, one can see that the very definition tells you that if the model is accurate, you don't need model risk, you don't need an inaccurate model. But by definition, if the model is correct, the VaR will be exceeded in 1 minus alpha %. It's the definition, it's a quantile. But practitioners yeah, they didn't really get this, at least up until the financial crisis. You can also use a mean VaR. You simply take the value of risk and subtract the expected loss. But from a statistical point of view, it's just a quantile. It's just a quantile. Okay. Now on this slide you can see a correct but a highly confusing way of defining a so-called inverse and generalized inverse of a distribution function. In fact, the only reason I gave you this is you need to calculate the VaR, you need the quantile function. In almost all relevant cases, the quantile function is the inverse of the distribution function. This is why you take f, the distribution function, and you put a -1 here in the power, and it's the inverse. However, if you look at special cases like a discrete random variable or an infinite random variable or other cases, you might have some cases in which the inverse function does not exist, theoretically. And then you need the so-called generalized inverse, which in many cases coincides with the usual inverse. And then you get the quantile function, that is Q, that is the generalized inverse of the distribution function. Does everyone know what a quantile is and how you can compute and estimate a quantile if you are given the distribution function? No. Who can explain it? The distribution function was what? The probability that L is smaller, oh no, L is smaller than L. So for example, the probability that you throw a 1 or 2 with the dice. The probability that you throw a 1, 2 or 3 with the dice. And what is the probability that you throw 1, 2, 3, 4, 5 or 6? It's 1. So the distribution function gives you probabilities that are being added up, and it looks like this. 0, 1. Okay. Now what is a quantile? It's the distribution function and you invert it. And you take it and you pull the inside out. You're not given a real value of the function and you're interested in a probability, but you turn it around and you give the function a probability and you're interested which value is the last one that is not exceeded if you are starting from probability 1 up until, for example, alpha. So it's the exact opposite of the distribution function. And with the distribution function, you simply add up the probabilities. And for example, here in case of a discrete random variable for a dice, what is the distribution function value for 3? It's just 0.5. And for F5, it's 5/6. The probability that you throw a 1, 2, 3, 4, or 5 with a dice is 5/6. And the quantile function is just the inverse of that. Now, for many parametric distribution families, the VaR is quite simple. For example, in case of a normal distribution, the VaR is simply given by mu, the mean plus the volatility times the quantile of the standard normal distribution. So this is a Z. In German, we also call this a Z-Quantil. This is a quantile of the standard normal distribution. Okay. We can also do the same with a standard t distribution with new degrees of freedom. Then it's also mean plus volatility times now the quantile of a standard t distribution. In this case, you don't need to estimate it. You can simply compute it. If you take the risk report as a part of the annual report of any bank, you will almost always find estimates for something that looks like this. This is from the risk report of Deutsche Bank. in 2006. A very handy example, because first of all, you will probably never see these kinds of profits at Deutsche Bank and its trading business, at least not right now. And you can imagine that this looked quite different in 2007 and 2008 at the financial crisis. So this is before the financial crisis, and those are the profits and losses from trading and the value at risk estimates Deutsche Bank used on a daily basis. And you can see that on some days, the losses came close to the value at risk. But I assume this is the 99 or 99.9%, and there were no exceedances. There were no VaR exceedances in this area, in this time period. Go to 2007, and you will see probably see a lot of hits. Question for you: is it bad if the VaR is exceeded? If you have a VaR exceedance?
For the bank, it might be bad because they don't know how much is exceeded by.
Yeah. Now, first, remember that the VaR is calculated for what? For calculating the necessary risk capital. So Deutsche Bank actually has a capital buffer that is as high as the value at risk, meaning that any loss that goes up to the point of the value at risk, Deutsche Bank should be able to recover from that. Beyond that, it is safe to assume that they are aware of the remaining probability that the VaR is exceeded. But, of course, if the loss is like this might be okay. If you have a loss that goes like this could be life-threatening for the bank. But at least this much capital is being kept as a buffer by the bank, and it might be able to cover these losses. You just unknowingly saw one of the main drawbacks of the value at risk. First of all, I already mentioned that VaR is not coherent. We will later on see that. But more importantly, the value at risk doesn't give you any information on the severity of losses beyond the VaR. It might be that the exceedances are just slightly beyond the VaR, or it could be the big hits I draw here on the plot. So you have no information about the severity of the losses that go beyond VaR, and this is where another risk measure takes. First, this result by Arzner, Eber and Heath: VaR is not coherent. It is not sub-additive. What does it mean? In special cases, for example, with the normal distribution, with the t-distribution, it is actually coherent, it is sub-additive, but for many distributions and in many practical applications, VaR is not sub-additive. And it means that it could be that if you take two risks and you estimate the value risk of those two individual risks, and then you combine it in the portfolio, you get risk capital measurement, and you get a VaR that is actually higher in the portfolio than the sum of the individual VaRs is. And this should not be. Diversification is punished by using a value at risk in some cases. And this is why, especially nowadays, regulators tell, or those two reasons, no idea about the losses beyond the VaR and missing coherence of the VaR. Those two properties have led regulators to ask banks and insurance companies to estimate some additional risk measures in addition to the value at risk, because they say, okay, VaR is not perfect. Okay. Now, we want to extend, yeah?
Doesn't the lack of being able to be sub-additive make it more safe for the banks? I mean, they have to ensure more risk capital, but when it's more, it's safer.
Yes. A good question. Now, the easiest way to come up with a risk measurement that is almost always on the safe side is to just do something like this. The VaR is 500,000. Let's just keep 5 million in risk capital. What is the problem here with such an approach?
Yeah.
Let's call it.
You have opportunity costs.
Yeah. Risk capital means, in many cases, equity. And equity is pricey. It's expensive. So you're missing opportunities and you're using up risk capital that could be put to a better use somewhere else in the company. And the company, the bank, the financial institution has a self-interest in keeping risk capital low because it wants to use its available capital somewhere else. So the bank on itself will try to use a risk measure that accounts for diversification on its own. And regulators have to agree with this if researchers tell them that this is not a very sensible way of measuring risk, right? Now, what can we do instead? We can estimate the expected shortfall. Expected shortfall, or just ES, is defined as follows. For a loss L with a more or less finite mean and distribution function FL, the expected shortfall is defined as 1 over 1 minus alpha, integral of alpha to 1 of the quantile function. And here you can see this is again the generalized inverse. And you take the integral of the quantile function and then you weight it with 1 over 1 minus alpha. This is, I would assume, the most general definition I can give you. But a much better way of looking at this is to observe that actually this is a type of average of different VaRs for different confidence levels alpha. But this also is not the most revealing interpretation and representation of the expected shortfall. Actually, this one is. If L is integrable and it's a continuous distribution, we have the following. The expected shortfall is equal to the conditional mean of L, conditional of the losses being larger than the value at risk. What does that mean? You take, now let's make it precise. Let's look at this in an exact way. Let's take a loss and not a profit and loss distribution. So these are the losses here that really hurt, right? We look at the value at risk. That means we have alpha here and 1 minus alpha here. So 99%, 1% here. And the expected shortfall is what? The expected shortfall is the average. It's the expected value of all losses that are larger than the VaR. So it's a conditional mean. And before we criticized VaR for not taking into account the losses that exceed VaR. And expected shortfall does exactly this. It calculates the average loss beyond the VaR. And this general definition I gave you earlier is applicable to all types of distributions and random variables. Now in the practical case that we have a real valued integrable continuous random variable, here you can simply say expected shortfall is the conditional mean of the losses beyond the VaR. Yeah?
I think the 99% should just be alpha.
Should just be?
Alpha?
Alpha, okay, yeah, could be. It's just a way of defining this, right? So I have 1 minus alpha here. If alpha is 99%, yeah, okay. So this is a conditional mean. And this is how you interpret expected shortfall. It's the conditional, the average loss conditional on the losses being larger than VaR. A result by Acerbi and Tasche. I think Tasche works for Moody's. The expected shortfall is always coherent. Full stop. This is a very strong result, and the reason why everyone, especially in regulation now, tends to work additionally with expected shortfall. One has some serious drawbacks with expected shortfall as well, but it's a good addition to calculating the valued risk. Okay. One serious drawback of expected shortfall is what? You have one serious drawback when it comes to backtesting. If you want to test the accuracy of your risk model and the accuracy of your valued risk and expected shortfall VaR, you need data. And assume you have 100 days. You look at daily losses. You have 100 days and you want to calculate the VaR. Then you have 100 data points. If you calculate the expected shortfall based on alpha being 99%, out of these 100 data points, you want to calculate the average of just one empirical observation beyond the VaR. So as you are looking at a very small portion of the tail of the distribution, data availability becomes a serious issue, and backtesting VaR is actually quite tricky. And this is a problem. And I think there's a paper that has shown that even theoretically, it is not possible to backtest expected shortfall. You can try, but theoretically at least, you will never get exact results. And this is a very big problem with expected shortfall. But as I've used up all my time for this first setting now, I would say we'll just stop here. I'll stop the recording and we'll take a 5 to 10 minute break and then continue.